Many people believe that personal finance and business finance are basically the same because both involve earning, spending, saving, and investing money. While they certainly share some financial principles, they operate with completely different objectives, rules, risks, and decision-making processes. Understanding this difference is one of the most valuable lessons for anyone who owns a business or plans to start one in the future. One of the biggest reasons businesses fail is because owners unknowingly mix personal financial habits with business financial decisions. A person who manages a household budget successfully may still struggle to manage a profitable business because the financial priorities are not the same. Personal finance is designed to improve your lifestyle, protect your family's future, and help you achieve personal financial goals, such as buying a home, funding retirement, paying for education, or taking vacations. Every financial decision revolves around improving your personal quality of life. Business finance, on the other hand, exists for one primary purpose: creating a financially healthy company that can survive, grow, generate profits, and increase its long-term value. Instead of asking, "Can I afford this?" business owners often need to ask, "Will this investment generate more money in the future?" That single shift in thinking changes almost every financial decision. Imagine someone earning $80,000 per year. They may decide to purchase a luxury vehicle because it makes them happy and fits within their personal budget. From a personal finance perspective, that decision may be perfectly acceptable if it does not create financial stress. Now imagine a small business generating $1 million in annual revenue. The owner may want to buy expensive office furniture, a luxury company vehicle, or an impressive headquarters simply because the business appears successful. However, a smart business owner does not evaluate purchases based on emotions or appearances. Instead, they ask whether those purchases will increase revenue, reduce operating costs, improve productivity, strengthen customer relationships, or provide a measurable return on investment. If the answer is no, the purchase may be delayed regardless of how much cash the business currently has. This difference explains why successful entrepreneurs often drive modest vehicles while investing heavily in marketing, technology, employees, equipment, or inventory that directly contributes to business growth. Personal finance focuses on consuming income wisely, while business finance focuses on allocating capital efficiently. Once you understand this difference, you begin thinking less like a consumer and more like a business owner who views every dollar as an employee that should produce additional value instead of simply being spent. Another major difference between personal finance and business finance is how each one measures success. In personal finance, success is usually defined by financial security and quality of life. People want enough income to comfortably pay their bills, build an emergency fund, eliminate debt, save for retirement, and enjoy experiences with their family. If monthly expenses are covered, savings continue growing, and financial stress remains low, most people consider their finances to be in good shape. Business finance measures success very differently. A business is not judged by how much money flows into the company, but by how efficiently that money is managed and how much value the business creates over time. Revenue alone does not determine whether a business is financially healthy. A company can generate several $million in annual sales and still lose money if expenses continue rising faster than income. At the same time, another company with much lower sales may produce significantly higher profits because it controls costs, prices its products correctly, and manages operations efficiently. This is why experienced business owners pay close attention to financial reports instead of celebrating sales numbers alone. Imagine two business owners operating in the same industry. Business A generates $2 million in annual revenue but spends nearly everything on payroll, advertising, office space, inventory, loan payments, subscriptions, and unnecessary overhead. After paying all expenses, only $20,000 remain as profit. Business B generates $1,200,000 in revenue, yet carefully manages expenses, negotiates better supplier contracts, improves employee productivity, reduces waste, and maintains healthy pricing. At the end of the year, Business B earns $180,000 in profit. Although Business A appears much larger from the outside, Business B is actually far stronger financially. Personal finance rarely requires this level of analysis because individuals usually focus on whether they have enough money to meet their personal goals. Businesses must constantly evaluate profitability, operating margins, cash flow, return on investment, customer acquisition costs, inventory turnover, and dozens of other financial indicators. Every business decision must be supported by numbers rather than assumptions. This difference also changes the way money is viewed. In personal finance, income generally represents the reward for your work. After paying taxes and living expenses, whatever remains belongs to you to save or spend. In business finance, company money is not automatically the owner's money. The business must first pay employees, suppliers, rent, insurance, taxes, lenders, software providers, and every other operating expense before the owner considers taking profits. Successful entrepreneurs understand that the business itself must remain financially healthy before rewarding the owner. Instead of withdrawing every available dollar, they often leave profits inside the company to strengthen cash reserves, purchase better equipment, expand into new markets, hire talented employees, or prepare for unexpected economic challenges. That discipline creates businesses capable of growing year after year, while owners who treat business accounts like personal wallets often experience cash shortages, delayed payments, and financial instability. Learning to separate personal financial goals from business financial objectives is one of the most important mindset shifts an entrepreneur can make, because long-term business success depends on protecting the company's financial strength before satisfying personal spending desires. One of the most important differences between personal finance and business finance is how each one approaches risk and investment decisions. In personal finance, the primary goal is usually to preserve wealth while gradually increasing it over time. Most financial advisors recommend building an emergency fund, paying off high-interest debt, purchasing appropriate insurance, and investing consistently in diversified assets such as index funds, retirement accounts, or real estate. The emphasis is on stability because a person's income is often limited to a salary or a small number of income sources. If an individual loses a job or experiences an unexpected emergency, personal savings become the financial safety net. For this reason, personal finance generally encourages avoiding unnecessary financial risks. Buying expensive items on credit, making speculative investments, or borrowing heavily without a clear repayment plan can quickly create financial stress. The objective is not to maximize short-term returns, but to protect long-term financial security. A household budget is designed to reduce uncertainty and ensure that essential financial goals remain achievable regardless of temporary setbacks. Business finance operates with a different mindset because businesses must take calculated risks in order to grow. Every expansion requires some level of investment before results become visible. A company may spend money hiring additional employees, launching a marketing campaign, purchasing new equipment, developing a new product, upgrading technology, or opening another location. Unlike personal spending, these decisions are not evaluated by how enjoyable they are, but by their expected financial return. Every investment should answer one important question: will this generate more value than it costs? Consider a small manufacturing business that spends $200,000 on automated equipment. At first glance, this appears to be a major expense. However, if the equipment reduces labor costs, increases production speed, improves product quality, and allows the company to serve more customers, the investment may pay for itself within a few years, while continuing to increase profits long afterward. From a business finance perspective, that is a productive use of capital. Spending money is not automatically considered bad if it creates measurable future returns. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.